Hi everyone, this is Eric from Traders Helping Traders with this week's Tricks of the Trade. For those of you who are having difficulty getting whipsawed in markets with bad timing, just all around frustrating trades, this particular lesson might be a real eye-opener for you. As a trader, our best opportunity to make money is with the trend. When the market is moving, that is when we are most likely to be making money in the market. When the market is in this sideways or consolidation phase, that traditionally is the worst time for us to be trading, and the time where we are most likely to incur a loss. So the big question then becomes, how can you identify the consolidation phase, and how can you identify the trend phase? And that's what this particular video is going to be about. Now, the consolidation phase itself is not bad. The consolidation phase occurs after a trend, and it's the time when the market consolidates. It's thinking about what it wants to do next. The bullish and bearish forces are pretty much neutral at this point in time, and very often you will see prices either move contrary to the previous move or sideways. A sideways move very much indicates that the market is in balance. The nice thing about a consolidation phase is actually our best opportunity to get back with trend. When the market is already moving like this with these big bars or strong moves to the upside or downside, it's very difficult to get on board. It's not impossible, mind you. You can always scale down to a shorter time frame and hope to catch a little bit of a retracement period, but even on the shorter time frame, you're going to be on the lookout for those retracements or consolidation periods, which will represent your best opportunity to get back with trend. All right, so our first indication that the market is no longer trending is when the bars begin trading opposite the primary trend. So here we have the October sugar chart. Sugar obviously in a downtrend. You can even look at your moving average lines. The 20 is stacked below the 55. Everything is suggesting this market is in a downtrend. Here sugar prices have started to rally a little bit, and therefore we would be on the lookout for our green-red bar combination, which shows us resistance and our next opportunity to sell. The problem is that very often you will get your green-red bar combination, you will sell, the market will bring you in, and then after a little hesitation, stop you out for a loss. Traditionally, our entry would be below the low of this red bar and just above the high. So we would probably have been stopped out on this particular trade to the downside, either for a big loss or a little loss, depending where you would have taken your lumps. So how would you be able to know that this market would not really head lower? Well, I've got a little bit of good news and I've got a little bit of bad news. The bad news is that it is very difficult to determine. In fact, there were a lot of traders who would have seen this, and it would be pretty much a textbook support and resistance trade, or a textbook trade of any method, really, because here we have old support. That's fairly obvious. The market comes up, hits the support region, boom, big bar to the downside. Everything is suggesting that perhaps the market will head lower from here. But of course it did not, because the very next bar it came back with support. So here's the bad news. The bad news is that every once in a while you will get caught on a move like this, and there's really not too much you can do about it. But having seen that the market is heading lower, or refusing to head lower, the next sell signal, which occurred right here, should have been taken with a certain amount of caution. Because now we have two support points, and the market is showing us that perhaps it is not quite ready to head lower yet. Notice where the market bottomed out. It bottomed out right on this support trend line. So what is that telling you? That is telling you that there are buyers down here. There are people who are buying this trend line support. And whether you draw a trend line on there or you just eyeball it, the fact remains that there is buying going on here, and it is making it very difficult to sell. So when you get this happening, it is time for you to sit on your hands. Sit on your hands and wait for the market to tip its hand, which it will eventually do. The worst thing you can do at this point in time is to continue to take signals which very likely will continue to fail. Now, a few weeks ago, I mentioned to you how when a market is in a retracement phase, it will have a tendency to make anywhere between 1 and 4 attempts to recapture the trend. By keeping track of how many times the market attempts to get back with trend, you'll have a better idea of when your best chance for an entry will be. Unless the market is trending very strongly, traditionally, the very first attempt tends to be the weakest. In fact, the first attempt will often set up to be a good counter-trend trade, but we're not going to address that particular issue in this video. The second attempt to move the market lower, in most cases, is a very high probability entry point. In this particular instance, it would not have worked out so well, but you already saw that there was possibility of some support forming here. Bear in mind, it is rare that the market will ever take off on you without giving you a second chance. Even here, where sugar prices fell sharply, and it would have been very difficult to get on in this part of the move, but after a week of declines, the market retraced, giving us yet another opportunity to get in short, and that too would have resulted in a nice move to the downside. Remember, it doesn't pay to be greedy in this particular game. You just want to be able to take your fair share and to be sure that the trades that you're taking are going to be high probability trades. All right, let's play this forward a little bit. Here is attempt number 3 to move the market lower. And you can see that it too failed right at the support trend line. A little while later, we got attempt number 4. Now, traditionally, if the market does not recover after 4 attempts, then it is very likely changing trend. So this is the last chance for the bears to take the market back. Now, notice that we have also broken the resistance. The resistance that was here at the 2240 support, and the 22 or the resistance at the highs here, which were also around 2240. And now we have the market coming back down and testing it as support. If it continues higher from here, well, then that's not only indicating that the 4th attempt to move the market lower has failed, but it is also suggesting that support is holding, and now we might be able to actually buy the market higher. And in actual fact, that's what worked out, where sugar got this very large rally. Now, before we get too far into that, I do want to point out one other tool that you can use to help you identify when you might be seeing a pullback or a substantial reversal that you might want to be a little bit more cautious about. And that has to do with the market trend itself. Notice here, once sugar prices crossed over and officially became bearish, you can either consider this point here, or you can consider this leg of the market down here. But generally speaking, once the market crosses over, either from bullish to bearish, or from bearish to bullish, you will see 3 pushes or waves in that particular trend. Now, this is kind of the basis of Elliott wave theory. I don't subscribe to Elliott wave theory, but nevertheless, it is still a common market occurrence and not really something that we should be ignoring. So here, the market has become bearish. This was the first bearish attempt. First push lower, second push lower, third push lower, and then the market hits all this choppiness and heads the other direction. Now, traditionally, and this is where I differ from Elliott wave traders, but if you get 3 pushes to the downside, you'll probably get at least 2 to the upside. So that's just a general rule of thumb, something to help guide you when you're working on improving your timing. So in this particular instance, we had 3 moves to the downside. I would look for 2 moves to the upside and then possibly the market to recover the trend and head back to the downside. Now, of course, all that is subject to what prices are currently doing, and these are really just general rules of thumb. Nothing in trading is written in stone, but it's something to keep in the back of your mind. So watch the price action. Watch how support and resistance are forming. Watch how far along in the current trend you are, and you'll have a better idea as to whether or not the signal you're getting is a good one and worth taking. That reminds me, there's one more thing you can do, and that is you can take a look at your indicators. This is sometimes where indicators are helpful because they'll filter a lot of the noise out of the marketplace. So this is our MACD indicator that we use for momentum, and you can see we've sped it up a little bit, but take a look at what happened whenever we got a signal here to sell. MACD kept going higher. So that's a very early indication that the market might not be ready to recover the trend. And it just adds a little bit of extra caution when we're taking the trade. So paper trade it, try to incorporate it into your trading, and hopefully it will help keep you on the right side of more trades. And that's this week's Tricks of the Trade.